Assalamualaikum warahmatullahi wabarakatuh. Our group will present the topic Credit Risk Management for Islamic Banks, Reducing the Credit Risk to Mitigate Losses. As we know, Islamic Bank is a banking system that offers Sharia-compliant financial services. They also provided service like conventional banks such as wadiyah, saving, murabahah, exchange contract, card, loan, and mudarabah partnership. But we are also know that every financial services that Islamic banking offer have their own credit risk. Generally, credit risk is one of the main risks that should be emphasized by banks when providing loans to the borrower. This risk can happen when the borrower fails to repay the loans. That's why the credit risk management is very important in a bank. Good management can reduce the chance of credit risk occurring. Credit risk management generally helps to screen and give an early warning to the bank whether can or cannot to lend to a borrower. That's all from me.
I will explain the definitions of credit risk management in Islamic banks, credit risk based on natural certainty contracts, and natural uncertainty contracts. First, credit risk is the potential of loss that will be borne by the lender due to the borrower not repaying their debts or repaying the loans that have been borrowed. By evaluating credit risk, the bank can extend the credit for those borrowers that are most likely to repay the debts and not extend credit for borrowers that cannot pay back. With this process, the bank can maximize its profit and reduce the losses. To prevent the occurrence of credit risk that leads to losses, the bank also must play an important role in appropriately managing credit risk and be free from elements of Sharia non-compliance such as riba, gharar, and maisir. Next, Islamic banks generate revenue through investments such as credit investments. There are two types of credit risk investments, which are credit risk based on natural certainty contract and natural uncertainty contract. Credit risk based on natural certainty contract is an Islamic bank credit that can generate a fixed income. This type of credit is related to Islamic banking products such as murabahah, buy as-salam, istisna, and ijarah. Credit risk based on natural uncertainty contract refers to the credit that can provide irregular income. This type of credit is related to Islamic banking products, which are mudarabah and musyarakah contracts. Both of these types of investments often have potential credit risk. The level of risk that occurs in Islamic banks is also different, and it is due to the different types of credit investments that are subject to the contract with the customer. So in order to reduce the losses, Islamic banks should always be selective in their credit investments. So that's all from me. Next, I will pass to the next presenter.
Next, I will proceed with the principles of credit risk management in Islamic bank. So, according to the Basel Committee on Banking Supervision (BCBS) in 2001, there are three key principles of credit risk management that covered many crucial criteria. Firstly, banks should be exposed to an appropriate environment, and resolution managers need to use a more effective strategy. Secondly, banks must have great loan procedures because banks are exposed to large and small risks in selecting projects and investment. And the last one is banks should maintain good credit administration, measurement, and supervision to avoid any inaccurate decision making.
There are three research methods that we use to collect data. Firstly, library research. Banking library research was the research strategy used to obtain information regarding Islamic banks' credit management. We look for relevant books, articles, and news. The library provided us with more information that was very helpful and educational. We came across an article titled Islamic Banks Credit Risk Panel Study that discusses the empirical finding that a few bank-specific characteristics increase credit risk in Asian Islamic banks. Secondly, online research. The information about credit risk management for Islamic banks was gathered using an internet research method. Online research is a type of research that uses the internet to collect data. The internet allows us to rapidly and easily get survey and questionnaire methodological data. It only takes a few keystrokes or a phrase into a search engine to find the information you need. Lastly, discussion in group. The significance of risk in the financial sphere, which includes statistics, financial management, and insurance, was discussed. This is a general discussion regarding the importance of credit risk. We discovered throughout our discussion that banks will confront a variety of risks in their operations, including interest rates, exchange rate, trade risk, political risk, and risk associated with changes in the value of tangible assets and goods. If the borrower does not pay back their credit card or loan, it will have a negative influence on Islamic banks' credit risk.
Based on the research that we have conducted, credit risk could have a serious impact on Islamic banking institutions or their customers. Credit risk reduction is one of the major duties of credit managers, because when given loans, there will be some credit risk that must be thoroughly measured to prevent outstanding debts or bad debts. There are several ways to reduce credit risk that we'll discuss to address this issue to mitigate the losses. First of all, it's important to determine creditworthiness. Assess the creditworthiness of the prospective borrower, as well as his or her ability to make future payments. This is to avoid the additional risk of late payment becoming a bad debt. The next step is to get to know your customers. It is an important type of regulation in certain industries, such as finance. Before doing business with a customer, verify their identity, profile, and financial situation. This is to avoid dealing with customers or borrowers who are already in debt. Following that, using a trustable credit reference organization for more in-depth investigative work can yield invaluable insight. Credit report can also be used to generate customer information and segment them based on credit risk and deduction. Moreover, it is critical to consult with industry contact and research the company's reputation, especially in terms of direct debit behavior. Use your internal resources, such as your sales department as well. This will result in a closer customer who will most likely be conscious if your financial condition changes. As a result, ensure that your credit control and sales managers collaborate. Setting an appropriate credit limit is the most important way to reduce credit risk. To accurately set a credit limit, you must first investigate the client's financial situation and review previous year's documentation to see how sales have performed in the past. Next, the working capital ratio of a company must be considered, which indicates its leverage and ability to satisfy short-term contractual needs. It is necessary to take into consideration the larger sector when determining credit limits. Also, we should learn about the sector behavior in order to minimize credit risk while recognizing the sector's growth prospects and challenges. With this, you should be able to minimize your credit risk and set favorable credit limits. Lastly, taking out securities arhano against credit facilities will also help Islamic banks reduce their credit risk. Nevertheless, if the debt is obtained with the promise of timely repayment, the bank is at the mercy of creditors because the lender risk in the event of default is high. The purpose of using arhano in the credit process is to protect creditors' interest, primarily by reducing the combined risk that customers meet debtor obligation most efficiently and securely.
When applying for a loan or credit, the lenders will look at the borrower's ability to repay the debt, creditworthiness, and how they manage the debt. One way to do so is to make a check with the 5 C's of credit, which are character, capacity, capital, collateral, and also conditions. As for the character, it is to ensure the performance of individuals in managing credit and making payments and the tendency to repay the loan on time. Other than that, the capacity of the borrower will be assessed by looking at the total income, employment history, and current employment stability to indicate the ability of borrower to repay the debts. The next one is capital. Capital includes savings, investment, and assets. It becomes an additional guarantee of unforeseen situation or setbacks. Collateral also can be taken by the lender as a security if the borrower unable to repay the debt. The last one is conditions. It is an external factor where the lender will consider it before lending, including assessing risk based on how the borrower plans to use the money if approved.
Next is Mudarabah and Musyarakah impact on Islamic bank credit risk. Mudarabah is not more dangerous than Musyarakah financing. The insignificant impact of Mudarabah source of finance on credit risk could be attributed to Islamic bank's low Mudarabah ratio. We also summarize that a higher percentage of Musyarakah will be a symbol of courage to be more qualified and productive in customers' loyalty and monitoring, resulting in less market distortion, oscillation, and moral hazard. Furthermore, we contest that the distribution of Musyarakah financing is due to the interaction of borrowers, Islamic bank, and clients. A higher proportion of Musyarakah may cause borrowers to trust Islamic bank because it indicates the bank expertise in the field of Musyarakah financing. As Islamic banks allocate more Musyarakah financing, they will gain more experience and ability in identifying favorable and unfavorable business. Moreover, bad firms may still confront Islamic bank for high Musyarakah financing, but we trust great business will have a greater chance and be more satisfied than experienced Islamic bank. This study found that participating in Musyarakah financing can reduce Islamic bank credit risk once the optimal share is reached.
In a conclusion, credit risk exposure has engendered a lot of attention in the banking and financial crisis as increased interest in this topic. Based on this study, Islamic bank also face the credit risk when occur the contract murabahah, baik salam, istisna, and so on. In this case, our findings offer empirical evidence to mitigating the credit risk by creditworthiness, getting to know your customer, using trustful credit references organizations, setting an appropriate credit limit, and taking out securities, which is known against credit analysis. Despite this, in our opinion, the Islamic bank in Malaysia still needs monitoring, eventually, and providing guidance to enhance transparency in risk reporting. The good management of credit risk for Islamic bank plays the role to reducing the risk. We pay attention to credit risk identification, measurement, and mitigation. The significance of effective credit risk management involve many parties, researchers, regulators to examine and assist them in the proposing a comprehensive credit risk management. Hence, mitigating credit risk is remain priority of bank management as a decreasing credit risk and maximize profit.